I'm Stephanie Link. I'm co-portfolio manager of Action Alerts Plus. Here with me is Jim Cramer. And today we're going to talk about financials. Jim, we are overweight the banks in the financials. We've enjoyed a little bit of a rally as rates backed up. Now we're seeing a little bit of a pause. What are your thoughts?
The two groups that are doing okay here right now, most aren't, are the techs with low multiple and the banks with low multiple. Now banks are giving up some of their gains because people are kind of shocked that rates went up. Of course, we need rates even higher for the banks to do well because all people really care about is net interest margin. We need them to be able to make money on a CD. They can't make money on a CD. We need them to be able to make money on your checking account. They haven't been able to. They've been mostly fee-based, and the net interest margin is coming down. So there are lots of people who are not expecting net interest margin to go up. And if it does go, if rates go up a little bit more, or if they just kind of stay here and so only work off, we get a more robust housing market in the second half because it's not so stunned by the higher mortgage rates, then the banks are going to have better than expected earnings, and that's really what we're looking for.
Right, and so if we get a steeper yield curve, that's good for net interest margins. If we don't, capital markets activity continues to be pretty robust.
Right.
We had Wells Fargo raise numbers today on the whole group based on that. Goldman Sachs stands to benefit, though these stocks have had a nice lift. So if there's a pause, I think we're kind of inclined to maybe add if you see a pullback, because the valuations are still not stretched.
Right, I mean, this group has not done anything.
Yeah.
Key was at 30, First Horizon 40, these are 10, 11. When people are picking stocks here, they want to limit their downside because it's kind of a negative market. They thought they could limit their downside in the bond market equivalent stocks, but when these yields went to 2.5, 3, that's not a lot of protection. So what they're resorting to is rock bottom value, and the banks have rock bottom value. They just haven't had any earnings momentum. But if you really do believe that the yield curve can get steeper, it's the number one group in the market. And I think that one of the reasons why the market's so paralyzed is there is a prospect of rates getting steeper. And if that's the case, this
normalized earnings then become more visible, and then you could really value these stocks, which is how people used to value these stocks, on normalized earnings. But then we lost all confidence over the last couple of years. So
well, the Fed also made it so they couldn't pay dividends, and the dividends, if they can come back, would be terrific. I was depressed to see the CDOs come back. Those we don't want that. We don't want any. I mean, those things. People are stupid to buy them, and it's just really great salespeople jamming them and then getting out of the business and going to the Hamptons. I wish the government would step in, but we can talk about it. But I do believe that if you want downside risk minimal and upside risk good, upside chance is good, then the banks are your group right now, given the fact that the other group that really had exemplified that, Seagate, Western Digital, Intel, Microsoft, they've moved big.
Right.
And so these stocks can still move, and every time you fear higher rates, you should be buying the banks.
There you go. Thanks so much, Jim.